10. Stress test your DCF and read the range of outcomes. Why a single number is never enough. A completed DCF model produces one share price, but that number rests on dozens of assumptions, each of which carries uncertainty. A small change in the discount rate, the terminal growth rate, or the revenue trajectory can shift the implied share price by tens of % in either direction. Sensitivity analysis exists to make that uncertainty visible and structured. Instead of presenting one number, a well-built DCF presents a range of outcomes tied to specific changes in the most influential variables. This is how professional analysts communicate valuation conclusions, not as a point estimate, but as a defensible range with explicit assumptions behind every boundary. What sensitivity analysis asks? Sensitivity analysis asks one question. If this one input changes, how much does the implied share price move? It does not change the narrative behind the model. It isolates individual variables and measures the mathematical effect of moving each one within a plausible range. The two variables that typically have the largest effect on implied share price in a DCF model are WACC and the terminal growth rate, because both directly determine the denominator used to calculate terminal value. A second pair of influential variables at the operating level is revenue growth and EBIT margin, because those two assumptions together determine the scale and profitability of free cash flow across the entire projection period. The sensitivity sheet in the Excel model runs 3 separate two-way tables covering each of these variable pairs. Part 2. The two discount rate tables. The first table in the sensitivity sheet crosses WACC against the terminal growth rate and shows the implied share price for every combination. WACC ranges from 10.0% to 14.0% across the rows, and the terminal growth rate ranges from 2.0% to 4.5% across the columns. The base case sits at WACC of 11.71% and terminal growth rate of 3.5%, highlighted in yellow. Reading across the row at the base case WACC, you can see how sensitive the price is to growth rate assumptions alone. Reading down the column at the base case growth rate, you can see how sensitive the price is to the discount rate alone. If WACC rises by 1 percentage point while the terminal growth rate stays fixed, the implied share price typically falls by a meaningful margin because the terminal value denominator widens significantly. The second table crosses WACC against the exit EV to EBITDA multiple for analysts who prefer to anchor terminal value to market evidence rather than a perpetuity formula. WACC again ranges from 10.0% to 14.0%, and the exit multiple ranges from 12x to 25x. The base case uses a 20x exit multiple at 11.71% WACC. Comparing the implied prices from both tables at the base case inputs gives you a cross-check. If the two methods produce materially different results, the terminal growth rate or exit multiple assumption deserves another look before the valuation is finalized. Part 3. Scenario analysis builds a narrative. Sensitivity analysis moves one variable at a time. Scenario analysis moves multiple variables simultaneously and connects them to a coherent business story. A sensitivity table can show what happens if WACC rises to 13%, but it does not explain why WACC would rise to 13% or what else would change in that world. A scenario does both. Bull, base, and bear scenarios each represent a distinct view of how the company's future unfolds, and every assumption within a scenario must be internally consistent with that view. In a bull scenario for a high-growth semiconductor company, AI infrastructure spending accelerates beyond current expectations. Data center revenue grows faster than consensus, and pricing power holds as demand outstrips supply. Higher revenue growth, stable or expanding margins, and a potentially lower discount rate are all consistent with the same thesis. In a bear scenario, cloud provider spending decelerates, competition from alternative chip architectures intensifies, and margin pressure builds. That scenario implies lower revenue growth, compressed margins, and a higher discount rate reflecting greater earnings uncertainty. The key discipline is that you cannot combine a bear revenue assumption with a bull margin assumption without a specific reason, because those two outcomes pull in opposite directions. Probability-weighted price. Once bull, base, and bear scenarios are defined, a probability-weighted implied share price is derived by assigning a likelihood to each outcome. The probabilities must sum to 100%. A common starting structure is 25% bull, 50% base, and 25% bear, though any distribution is valid as long as it is explicitly documented. The spread between bull and bear defines the valuation range an analyst presents to a client or investment committee. Part 4. Reading the scenario table and using AI. The sensitivity sheet in the Excel model displays the 3 scenarios in a summary table, showing assumption differences across revenue growth, EBIT margin, terminal growth rate, exit multiple, and WACC, alongside the implied share price for each. The base case is highlighted in yellow. A wide spread between the bull and bear prices signals substantial forecast uncertainty, and the analyst should identify which specific assumption drives that width rather than leaving the range unexplained. Using AI to build scenario assumptions. Constructing credible scenario assumptions requires current information about the business, the industry, and the competitive environment. Use this prompt for the case study in this module. Based on the NVIDIA's most recent earnings call, 10-K filing, and analyst commentary published in the last 3 months, propose internally consistent bull base and bear scenario assumptions for the following inputs: data center revenue growth for the next 3 years, EBIT margin trajectory, terminal growth rate, and WACC. For each scenario, explain the specific business conditions that would need to occur for those assumptions to be realized. Cite your sources. The AI output gives you a starting framework for the scenario table. You then review each assumption against your own business analysis and adjust where the AI has made generalizations that do not fit the specific competitive dynamics of the company. The final scenario table should reflect your own judgment, informed by AI-sourced research rather than substituted by it.